Welcome back. So, spring is here. We are 2 days into spring, and typically in real estate, if you didn't already know, this is when our market starts to go like this and head up. And then by the time we hit June and summer, we are peaking. Okay? However, this is not a typical year in real estate. And it all started about this time last year in 2022. And it has to do with this thing called interest rates, mortgage interest rates, and how the increase in interest rates has impacted over the last year the real estate market. It's always about supply and demand, but sometimes there's reasons behind the supply and the demand, like what causes low supply or high demand and low demand. And over the last year, the number one thing has been with the interest rates. So I shared a post on social media a little bit ago, and I promised to follow up with a little more detail on the 4 points in that post that talk about the reasons behind interest rates and their impact on the housing market. So here we go. I'm going to break them down one at a time, exactly what was in the post. And I'm going to just talk a minute or two about each one in more depth. And if you have questions or anything as we go, please drop them in the comments below. I love to get back to people. You can leave just a comment and I'll respond there. If you want to leave contact information, email or whatever, I can hit you up privately as well. Also, don't forget, subscribe to my channel. I've been trying to record a lot more content, a lot more purposeful content. Every couple days or so, a lot of shorts, a lot of long-form videos as well. But here we go. Point number one, by the way, I have it over here on my other screen, so I'm just going to look over here and I'm going to say point number one is low interest rates make it easier for people to afford a mortgage, leading to a rise in home sales and an increase in home prices. This is true. When rates are low, the demand for homes increases. We got a lot more buyers out there. People that are really penciling it out can understand that, I can afford X amount when I thought I could only afford Y amount, right? And it brings everybody out. People, when rates are lower, people also tend to max out their budget or maybe even try to go beyond a little bit of their budget, like really stretch it, because they understand that the lower rate is giving them, and it's affording them that opportunity. Now, conversely, because of that, that leads to a shortage of supply as well, because we just have more buyers than we can with homes available. And so that leads the prices up. You get the multiple offers within days or hours of hitting the market, right? You get 2 offers, 3 offers, 10 offers, 20 offers, even within just a matter of hours or a couple of days. That's what happens when we have the low interest rates. That's what we've had since 2008, 2009. We've had these historic low rates. We went 12, 13 years with rates that I think people started to believe that they were never going to end. In our industry, we started telling people as early as maybe 2016, 2017 that, this might be the year that the Fed raises the rate. This might be the year that the Fed raises the rate. You better get on board. If you're looking to move up out of your house, looking to downsize, move into something else, whatever you're looking to do, this might be the year to do it, because we're hearing the Fed might raise the rate. But it didn't happen year after year after year. And I think people just finally got like the cry wolf syndrome that it's never going to happen. Yet here we are. A year ago, right now, is when the interest rates started going up. And they peaked around June, July timeframe of 2022. So there you go. Point number 2. High interest rates can make it a little bit more challenging to afford a mortgage, leading to a decrease in home sales and a drop in home prices. There's a lot of truth to this, but you have to look at it from a certain perspective. High interest rates can make it more challenging to afford a mortgage. That's just budgeting, right? You thought you could afford $1 million home. The interest rate goes up by 2 points, and now you can only afford a $850,000 home. Well, that shrinks significantly, especially in our market here in Orange County or in California altogether. The type of home you could get, the size of the home you get. You may not be able to get that single family detached home that you thought you could get Now you're looking at maybe an attached home or a smaller single family detached home, or you're just a flat out condo situation or townhome situation based on just on the interest rates alone, shrinking your affordability. Now, the other part of that point number 2, leading to a decrease in home sales and a drop in home prices. Okay, but let's look at that. The decrease in home sales is a direct relation to the fact that the person who needs to sell their home most likely is on a current interest rate a lot lower than what they're going to have to move into. So this gives them pause now to be, okay, can I really afford to move into another home? Because I'm going to go from this 3.5% interest rate to a 6.5% or 7% interest rate, and they have to look at their affordability as well. Now, if they're lucky and they bought at the right time previously, maybe they have enough equity that they can overcome that challenge. They can buy down their rate or just not worry about it at all because they're putting so much equity into their new purchase. But that has caused a lot of sellers to themselves to back out, thus decreasing our supply. Now, the third part of point number 2 talks about a drop in home prices. Now, I want to let you know that that doesn't mean the market value is dropping of a home price, right? How I interpret that is the drop in home prices is when a seller is now bringing a home to market. If they've been really looking at the lay of the land and how things are, they're really not going to be able to take advantage. Just because there's a low supply, the high interest rates have backed off some buyers that you really can't now take advantage like you could have in 2020, 21, and even early in 2022. Take advantage of the smoking hot market and say, okay, I know I could list here, but my value is really 10% higher. So maybe I'm going to extend and push for that 10% higher as a list price. That's what you can't do. So in that regard, that's how I look at the prices coming down or causing the prices to come down. Is just, you can't overinflate as a seller at this point to try to take advantage of the supply and demand because of why the supply and demand problem exists. Hope that makes sense. If it doesn't quite make sense to you, please let me know. Drop a comment, let me know. Let's go on now. Point number 3 in the post from earlier today. Low interest rates can also lead to more competition among home buyers, driving up prices and making it more difficult for first-time home buyers to enter the market. That is completely true. It got to the point in 2020, 2021, and early 2022. What happened was before the pandemic, right? A lot of first-time home buyers were starting to get crushed out of the market. Pandemic hits, everybody has to back out now for like 3 to 6 months because you just don't know what the uncertainty is of the situation, the market, and everything, jobs, all that other kind of stuff. In that time frame, though, when first-time home buyers re-entered the market as we came out of as the market started opening up, even during the pandemic, what we started to see is people started to borrow sums of money from friends and family. People started to cash out any equity positions they had in any other properties, and maybe taking giant 401k loans, basically coming out and positioning themselves, even though they were a first-time home buyer, as a cash buyer to compete against actual cash buyers or compete against seasoned buyers, because right before the pandemic, they were getting their heads crushed in. And so once we started coming out of things, we saw a lot of people really just like pooling their cash together to be a cash buyer. And then once they would close on the home, then they would refi, take that equity that they had from their cash purchase, repay friends and family, repay their 401k loans or whatever other positions they pulled equity out of to make that happen. Now, it still is a challenge. It was a challenge then, and it's a challenge now, even with the supply and demand issues that we have for true first-time home buyers, simply because the higher interest rate, again, shrinks their affordability, just like it does anybody else's affordability. So they may have minimum requirements of their first home that it just doesn't make it feasible for them. It makes it very, very, very difficult. And then they're caught in the catch-22 of the rent versus own, rent's going up, and it could just be like a really big, ugly mess. That's just it. If they're lucky enough to have done what a lot of first-time home buyers and just home buyers in general did there for the last couple of years and make themselves a cash buyer, that's awesome. If they still have that capability today, that's awesome. But definitely point number 3 there hurts the first-time home buyer for sure. Okay, point number 4. High interest rates can also discourage people from refinancing their current mortgage, leading to a decrease in refinancing activity. There you go. That should be pretty self-explanatory. A lot of times in the lending industry, and I'm not a lender, but I'm friends with a lot of lenders and I work with several really good lenders here locally. A lot of times lenders they're very cyclical with their business, just like we are in sales, in real estate sales, right? So interest rates are low. They're doing a lot of new purchases, and in the hot months of selling, like spring and summer, they're doing a lot of purchases. But then when the normal market tapers in the fall and the winter months, they kind of switch to trying to do refis for people. Maybe someone that bought a home 3 or 4 years ago when it was a little bit higher rate, and now we've bottomed out. Hey, it's a good time to refi, take advantage of this new rate. And that kind of keeps their business more steady. The problem being is that how they suffer just like a real estate agent suffers when the interest rate goes up as much as it's gone up. Because we've had historically low rates for such a long time, it's really hard for somebody in the lending game to call up past clients and convince them to refi into a rate that might be double what they've been. Like, what's the advantage there? That really, 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 really hurts the refinance person. Maybe even the person that wanted to take out some equity. They have like a lot of equity they want to take out because maybe they want to remodel their home. And it makes it challenging for them because now they're going to take out equity and refi, even if it's a HELOC or whatever. The interest rates are just not as advantageous to do that. So it hurts current homeowners and people wanting to refi with these high interest rates. So I hope that gives you like a little bit more understanding of how this post came out earlier today, understanding what the interest rates are. If any of my lending friends see this video, or if you're a lender out there and you're local here in Orange County or Southern California, I'd love to do like a follow-up video and we both just sit there and talk. Let's just talk about the market. Let's just talk about the rates. Let's talk about where we each see things as they are today and maybe coming here over the next few weeks and months. Definitely leave a comment, hit me up. If you know me personally, give me a call. And let's just make that happen. But otherwise, please subscribe, please comment, let me know feedback. I enjoy getting to share information. I just want to make sure that I am giving useful information. So if you've even got, recommendations of subjects you'd like me to talk about with real estate, please let me know. Take care, everybody. See you again soon.